international operation. So
Yeah.
that's where we are, man. That's where we are.
That's where we are, man. Well, with that, let's kick it off. So here we are, the official start of the first episode here of a new podcast show from the Swami Research Channel, and we'll call it working title Jimmy Real Assets. So Jimmy, welcome to the show. It's great to have you. Longtime friend, internet friend, and with a hell of a background. So it's an honor to have you here on Jimmy Real Assets. Try to do this weekly or so, but we'll see how it goes. Wanted to ask you today, let's just talk. I figured we could just chat about the world of real estate, the world of small caps, weed, stocks, or just weed in general, and whatever's on top of your mind. So first of all, Jimmy, great to see you, looking good. Let's see that sweatshirt one more time for the
one time. All right, Turtle. Good to have you too. Thanks for having me on the show. This is Santa Claus, muscle Santa Claus, and his bags. So you see the size of these forearms? I'm not quite there yet, but give me a couple more quarters and we'll see where this bad boy goes.
That's right. That is right.
Yeah. It's a wild time. It's finishing up 2022, thinking about this time last year. Do you remember how fragile the market was, even at the top?
That's right.
It's there's a psychological component to this all where you always want to catch a good bubble, but the hard part is getting out. And often that last third, that last ride is the hardest because the FOMO is real. Things don't make sense. People know we're in this, cycle. And we knew that the tightening was happening. But in hindsight, it was all one big correlated trade. Whether it was a cyclical one or a secular one, here we are.
I've heard someone describe the history or the year in stocks. If you look at the S&P or whatever, it doesn't matter actually. Look at anything. It's a golf ball bouncing down a concrete staircase. Forgot who I heard say that on like a podcast or something, but I thought that was so well described. I mean, look at this. It's just, bounce, FOMO, fear, hope, greed turns back into fear, turns into more fear, turns into capitulation. And then right when everybody figures out we got to just go short, buy some TSLQ, some BITI and live your life, then we rip and then you lose the rest of your money. So it's been a difficult year.
It slaughters bulls and bears alike, and this chart doesn't really show the volume profile that on the other side of this liquidity cycle, the bounces get thinner and thinner on liquidity, even though they're vicious on a percentage basis. And, a lot of people, when you're down, all it takes is one trade. But there's a lot of psychological traps, and people are going to learn from this, hopefully, in hindsight.
Yeah, they should. Yeah. I think, when it's all over, I don't have any insight into the future that you don't, but, when it's all over, I think that's this could be like the next generation that they talk about that like stays away from, like, I guess it was the greatest generation that like stayed away from stocks for years. This could get that bad. I think about how much buy-in. I know, Jimmy, you never really took the orange pill on crypto, right? You never really got in there.
No, I missed it. I was mining for my computer back in the day, and just didn't give it a second thought. I'm sure there's a hard drive somewhere with some Satoshis, and that has also been a liquidity trade. We got a lot to cover today, but it's all, like I said, that the correlation is uncanny. When it comes to liquidity, whether it's in real assets or digital assets, this is a very interesting, it's a setup, but it's there's some takeaways. So happy to discuss what's going on.
Yeah, 100%. That is how long ago, dude, mining? I mean, you were making money doing that when, in like the early in the aughts? Like what year was that, you think?
Probably after 2010. It's
Yeah, wow.
right. I graduated in 2008 from undergrad, right when the world was blowing up. And in the wake of that, particularly among the disillusioned, looking at how we bailed out the financial system, we blended and extended. Um, the idea of finite supply from the money side, I think, and this kind of technological creation by Satoshi is something that caught people's attention, and it lay dormant for a while. But in this last liquidity cycle from March 2020 onwards, we've seen that to great effect, and now we're on the other side of that.
Yeah, yeah. The what was interesting is that yeah, I mean, that is like Raoul Paul says, right? It's the anarchy trade. It's like, and I think that we're seeing a lot of that now, maybe with just collective like disillusionment, you might say, and wait till they get, wait till we get to the bottom of kind of everything that's being torn apart right now. And I could see a situation where the people are just, again, it's back to the, like the coming out of GFC, people are like, what the hell? I don't want to play this game anymore. And I think that there's a lot of similarities to, like you said, the setup today, maybe.
100%. People don't like the game. They feel disenfranchised. They don't know it. They feel late. So they want to create another game.
Right.
And another game.
In crypto, and I think we both know this guy, these guys in this avatar, I'm trying to say, where it's like crypto is the way that you can kind of shortcut, right? You can make 1,000 to 1 or something. So I don't really have to save and just put money in a boring ass, Vanguard mutual fund. If if I can make 1,000, 100x with this crypto investment somebody told me about. And so that it concerns me even more that now again, it's just a series of ruggings. And the question is, how do you get up? But I think the way is you buy some real assets and or just some, in general, I think part of what we want to talk about, right, is like there is a lot of opportunity in this as well. A lot of these SPACs were decent companies. Maybe not a lot percentage wise, but definitely out of the thousand. How many companies came public this SPAC?
Easily hundreds, right?
Yeah, yeah. I was talking to a buddy the other day about this company. I think this was the biggest SPAC at the time. This is that mortgage company, right? That's the Detroit. It's like the Rocket Mortgage killer kind of. The alternative to Rocket Mortgage. These guys go UWMC. These guys go through they're like through brokers, right? Versus Rocket is like you just, we'll do it for you essentially. So these guys are like I don't know, but I'm trying to think the financial services similarity, but essentially instead of being Vanguard like Rocket Mortgage, they're trying to be the full service Morgan Stanley guys, or they go through Morgan Stanley, if you will. And so what's interesting here is like you get a stock that $10. This is a great canary for the broader risk assets, right? So back in March, this thing came out, man, right in the depths, or I guess
quite early.
Yeah, quite early, right?
Yeah.
Of course, you get your classics. This was in the days when SPACs were free money, right? Because you couldn't lose. You could always redeem at $10 when the transaction announced, but you could trade the hype, right? And so SPACs were going from 10 to 14 on a regular basis, or a lot higher. Some of them were more exciting than mortgage services. And then it's just like, this is the story of 2021, 2020. It's just wild, man. So this was tangential. I didn't mean to go into this, but the point is just that, like, talking to some people in the industry, this is an interesting company and they do a good job. They're ran by there will be some babies thrown out with bathwater, and that's what we can, probably spend the next couple of years watching balance sheets and somebody that has the background that you do, hopefully identify some wheat from chaff, you know?
Yeah, I mean, the funny thing is the hindsight is always so clear. And what's becoming more clear to me every day as I talk to companies I've invested in that are down 70, 80, 90%, just like this chart. I mean, this company's only down 60. Come on.
Right,
It
right.
could be
That's
it could be
nothing.
down just on liquidity
Rookie
alone. It
numbers.
could, yeah, rookie numbers. But when you think about the private to public capital market cycle that we saw this entire, from 2009 onwards, culminating at the highs last fall, every year as better and better companies went public, as interest rates went lower and lower, the game for these companies was to generate revenue, growth at all costs, scale at all costs. And companies that had no business being public, or companies that self-reportedly were in their Series A, Series B stages. If you have a comp from 2018, 2019, and you were a pre-seed or a Series A company, you find yourself in 2021 with this wild capital market and a banker or a sponsor pointing to the public market comp saying, hey, you could get this valuation, right? You could get this valuation. Right. And it was a money grab. So it's not an indictment on the quality of the businesses. Now, certainly many companies have an unsustainable business model. When you have negative gross margins and you lose money for every dollar you generate, but the public market values you on revenues, you're incentivized to grow and lose more money. But now that's seemingly no longer the case. I think the goal over the next, I'll even say few years, the visibility is terrible right now, will be to separate what companies can grow into sustainable businesses with cash flow, with relative comps to help, the incremental capital allocator think about what the future looks like, versus a lot of these names that are now heavily retail owned, where the marginal buyer and seller is involved in 20 other things. And on any given day, if there are more buyers than sellers, the stock goes up. If there are more sellers than buyers, the stock goes down. And as liquidity continues to drain and we stay higher for longer, perhaps, the writing is already on the wall.
Yeah. And yeah, and that's specifically, like, you're talking about like SPAC land, cannabis. Like, is it like, just to call out specifics, right? Like, that's kind of what you're talking about. Retail heavy industry. So SPAC, cannabis, crypto, right? That's what
SPAC, cannabis, crypto, meme stocks, even Tesla, right? And it's tricky. It's even a wilder ride once you suck in the institutions. Tesla is the poster child for a period of time in which the market was able to front run S&P inclusion for about 7-8 months. So when you have speculation run amok, you have people piling into the name, the institutions have to buy us now, right? They have to buy us now. And undoubtedly, this chart doesn't even fully capture the madness. If you think about the reverse splits that have happened, or the stock splits that have happened, people rode this from 2000 to 200 or to whatever the split adjusted basis is, right? We're looking, even pre-COVID, you think about the bubble between 2018, the last 4Q, and March 2020. I mean, this is this is a
$20. Right. No, I mean, it's a 25. What is it? We're down to like 20, 25, $26 during March 2020. And yeah, to your point, it came into COVID at 60 and it was a bubble then. And so that is, he almost like, this is, I mean, he is, nobody really has, I've never seen in some ways you could almost like, this chart is not that different from like Elon Musk's like popularity rating, right? In some ways, like he goes from, the savior of the species to now like he's getting booed off the stage at like comedy clubs in San Francisco. And that happened very quick. And what exactly happened is above the scope of this show. But the point is that it's just when you're not buying cash flows, right? When you're not buying real assets, I keep saying that word, real assets, and I don't. It was not even by design. I just thought it was kind of a catchy name. But when you're not buying cash flows, operating businesses with long track histories, what are you buying? You're buying hope and fear and greed, and no chart better exemplifies that than Tesla, I don't think.
Yeah, I mean, if you were to compare the company's actual free cash flow, you'll see that the cash flow is skyrocketed. I don't think anyone doubts that Tesla is a real company that has a business model that has visionary leadership, if you like the company, even that's disrupting several industries. But it comes down to forward expectations. So whether it's Tesla, whether it's Meta, that stock is down 70% this year, Facebook.
Yeah.
When you look back at their trough periods from 2017 and 2018, and you look at the analyst 5-year earnings estimates, a lot of that bullishness was priced in. And now we're on the other side of that. But you can say that Facebook is a bigger company today. They are a more influential company. They are a more powerful company. But that doesn't matter.
Yeah. So where do you want to start? You want to start with I got some real estate stuff I want to ask you about. Some talk about wheat stocks, talk about the dollar. Where would you like to start?
Let's talk about real estate. What is even real anymore? I find myself asking this a lot in this post-pandemic landscape where I think behaviors have changed, particularly in real estate, where the liquidity dynamic has changed. Real estate really ultimately is at the intersection of lifestyle, of capital markets, both on interest rates as well as just risk appetite. And this is going to be a very, very difficult period of time for us to assess. If you think about going back all the way to the beginning of capital formation, real estate is finite. It's location, location, location. There is a cash flow aspect as the landlord, but it's an asset class where the average person has more than 50% of their net worth tied to their home. It is their greatest source of net worth for many, and it's the most illiquid. It's an industry where transaction comps matter. So there's both a forward-looking aspect when there's hope and speculation, as well as a fear and a backwards-looking component when the comps start going the other way. But it's the end of 2022, and the big headline is that Blackstone is they're throwing up the gates. People want to get out. They're not taking their marks, and they've been the incremental buyer for years and years. The amount of capital raised in the sector to the smart minds in the room was incredible. So this is merely a chart of Blackstone, but you think about their real estate operation and their ability to I wouldn't say flip, but to aggregate assets. They've done as good of a job as anyone, but they've benefited from very low cost of debt financing, an incredible amount of leverage, and this tide that lifted everyone up. And now they have to be the one to share the bad news.
Right. Well, I think the chart I'll pull up while we're talking here that I think is really fascinating is the chart of yields, right? So let's look at just 10-year yield, and let's just zoom way out here, and I'll try to just talk for a sec. But but the point is, to your point, I think it's people think, and not like people think like I have this all figured out, right? But generally, I talk to people and they start with okay, well, I want to make money in real estate because it's tangible. Stocks, you can just get rugged. No one really knows why. Point, fair enough. But with real estate, it's tangible and it's real. And you know, that is that's true, but like that's not, real estate really is a story of leverage, right? I mean, like really what makes real estate such a great investment is leverage. And this is not doing what I wanted it to do. We got weekly bars? Yeah, we got weekly bars on TNX. So for the 10-year treasury, we can go all the way back to looks like the early 80s. Okay. And the point here is like the rates go, this is generally speaking, don't worry about every little, dip and dive, but like generally speaking, rates have gone down since Jimmy Carter was president, right? And now, depending on who you ask, but they definitely have broken out of a range. Are they going up? I don't know. I don't think either of us really knows. Actually skeptical. I was skeptical they'd be able to get them this high, so that shows what I know. Mm-hmm. But point being that that cost of capital is such an important component of real estate, and we may be in a new cost of capital regime, and so that could be because that's the single biggest. If you had to give a why, that's why XLRE is down 25 this year, right? Well, isn't that the single big? I guess that's a question in the form of a question. That's what else is? I mean, other than XLRE, being a bunch of stocks, right? Prologis is the biggest holding, I think, or AMT. These are stocks, or they're not. It's not single family homes. But would you say the biggest reason that XLRE is down, I think, 25% this year? I'll double check that number. It's just a function of interest rates, right?
100%. It's a function of interest rates and liquidity. And the good thing about liquidity is you have a mark to market. And the bad thing about liquidity is when people have to sell, they sell the things that are liquid and they don't take the marks on the things that are not liquid. And you mentioned, the idea of being in real estate. Yes, it's real. Yes, there is an NAV. But that NAV is completely cost of capital dependent, and it's completely dependent on what your neighbor paid for his or her property. So there's a strong psychological component, and there are self-fulfilling prophecies, particularly when you can borrow at zero. If you have great credit and you were borrowing at 3% or 4% 2 years ago, imagine what a multi-billion-dollar company could borrow at, and their ability to lever. This is the only asset class where an individual can get 80 to 90% leverage or even higher. It's a call option.
Right. Yeah. Yeah, 100%. Yeah, I think that leads in well. Let's pop over to Twitter here. I wanted to ask you about these, like, where do you like to hang out? Like I guess let's start high level. Are you interested in real estate? I think I asked you. I don't think you're long a bunch of REITs. You're not long a bunch of REITs currently. Is that correct?
Yeah, I have zero interest in real estate right now. Thematically,
really?
there are strains at the fundamental level. When you look across asset classes, we are coming off of peak occupancies, peak pricing power for the landlords, and peak liquidity, ease of access to cost of capital. So just those three things alone, there's going to be a shakeout period. And when you see the cracks appear on the wall, that's not when you plug it, because there's a tidal wave coming. The goal is to rebuild the house after the hurricane is blown past everything and things are getting destroyed. Because if you believe that things are real, there's value for land and there's value for what's being built on top of it. But we are really at a very interesting cross section now across many commercial real estate asset classes, where people have to think about residual value and intrinsic value and what is the best incremental use of this space? There's so many mega trends, just as a landlord, you get exposure, even though you're in real estate, you get exposure to every facet of the economy. So you've got you've got the antenna tuned in to what's going on, and it's difficult to even name one sector of commercial real estate that has a bullish near to medium term outlook. And not to say that in itself isn't a contrarian indicator that things have been oversold, but you and I both know, and I think our viewers know, that things can get irrational much longer to the upside and to the downside. And when you're playing with leverage, right, when you're coming in pot committed with a debt obligation, that's a difficult proposition for an institutional investor to make, let alone an individual investor.
Right. Yeah, and so that makes a lot of sense. It's the fact that across real estate asset classes, it's all a function of cost of capital, and since we're resetting on that front, it's just really hard to predict how this is. That the liquidity comment is very good. So okay, so just to set the stage, so the BREIT thing, so it's going to form a question. So I understand the BREIT thing to be like, and tell me where I'm wrong on this. It's like, yeah, it gets appraised as opposed to traded on exchange. So
which in and of itself is not uncommon. It's a standard practice for many private equity real estate funds, for many non-traded REITs. So this is more of an accounting idea than a practical one, but in and of itself, there's no legality issues. There's nothing sketchy, right?
Well, no, sure, but let's start there actually, because that brings up a good point. Why, like, and again, I'm not. Well, we're just two guys talking, so whatever. But why would you even want? Like, what's the point of buying a private REIT? Would you buy a private REIT? If I was going to buy a REIT, would you rather buy a private REIT or a public REIT? Like, is there any real benefit to the private REIT in general? I mean, I've heard him describe, actually, Josh Brown in his book called Backstage Wall Street called them murder holes. And I've never really been able to think of it any other way. But do you want to defend the private REIT industry really quick before I?
Yeah, this is not a defense so much as just a series of statements about what a public REIT is today in 2022 versus what it might have been, let's say, in 1994 when the modern REIT era kicked off. So the market cap across all REITs has dramatically expanded since the mid to late 90s. You can imagine this cohort of companies that came out that rode the wave of lower interest rates, that upgraded their properties. And in the United States, the publicly traded REITs own some of the highest quality and most liquid real estate out there. So that in itself is a plus, but you can see how it lends itself to a particular type of asset that is higher quality, but that is not really reflective of the broader real estate landscape in America, where the majority of real estate continues to be privately owned, whether it's by individuals, high net worth offices, or families that have an incredibly low basis. I think everyone is at least somewhat familiar with the idea that you have a lot of these wealthy families that own a lot of real estate in Manhattan, in California, right? You hear about these stories of the families and their empires, so to speak. But when you look at the private REIT model, typically these are smaller companies that are trying to raise capital. They are able to take on more leverage akin to a private company or to an individual. So instead of being 30 or 40% levered versus, let's say, your market cap, you're able to go full degen. You're able to take on 60, 70, 80% leverage. You're able to create more as a REIT, as any private entity that is not under public shareholder scrutiny. You don't have these quality metrics. So the purpose historically for REITs is to be a cash flow vehicle, people want their dividend yields. That's the nature of the structure. So many mom and pop investors throughout the 90s and the 2000s, and you think about where we were on the interest rate cycle, when risk-free rates are 5, 6, 7%, you had very decent, they're not the highest quality companies, but you had many private REITs paying a 10% divvy. And when you have that in a non-mark-to-market structure for someone who doesn't want to pay attention but is clipping a coupon, right? Grandma Sally needs 6% on her capital. She doesn't need 2% with capital appreciation, but she has income needs. So the purpose of the private REIT has remained steady, but it's been leverage focused, dividend focused, not so much on total appreciation. And therein lies some of the pitfalls. The devil's always in the details, but we're going to circle back to BREIT on this. But particularly as far as compensation, the adage goes, show me the incentives and I'll show you the outcomes. But
That's right.
we find ourselves at this pivotal moment where there's a increased scrutiny on compensation, on incentive structure, and some of this bad acting, whether it was in good faith or bad faith, is coming to the forefront.
Right. Yeah. Yeah, no, that makes a lot of sense. So in general, to set the stage on the BREIT thing, I think we talked about a little bit, but what's interesting is, so because it's appraised and not traded, it basically, these guys, to my understanding, haven't really seen a markdown, or they haven't seen a markdown at all to this point on their NAV, right? They're still trading it at their NAV from 2021 or whatever, early 2020.
Absolutely. And often the appraisal is done yearly. It's not a quarterly NAV.
Gotcha.
It's an annual revisit. In many
Yeah.
countries that have adopted IFRS reporting standards, this is a long-term, smoothed out type of appraisal process.
Yeah. Okay. Let's talk about that real quick, because man, I love learning about all this REIT nerd stuff from you. IFRS, that's the international accounting that specifically REITs follow, or that's international accounting in general?
IFRS is I guess it's a type of reporting, standard that companies in Canada follow, that companies in Europe often follow, where they hire an external appraiser who looks at private market transactions across the landscape, looks at historical trends, that makes certain assumptions about stabilized occupancy, which is another tricky thing. It's not actual reported, company level metrics, but it takes an industry aggregate on both occupancy as well as cost of financing to arrive at certain assumptions about what NAV is, or what a stabilized NAV might look like.
Yeah. Yeah, that makes a lot of sense. So yeah. So basically, so here's a question for you. Let's pull up something for you. This guy, Barksdale. Here's a guy, shout out, all you REIT fans. Barksdale. Great. Now I'm not going to find it. I'll just do this. Bark. What is this? Let me send it to myself. Yeah. So, we'll come back to it. But this guy but here's the question, and I'll find it really quick while I'm talking. The question is, so a lot of these real estate guys, or a lot of these, so for example, EQR, I was noticing like he had a table, and I'm going to find this, here it is. This guy's a great Twitter account. But, here it is. BARK, non-stabilized, that's what it is. Sometimes searching on Twitter is a pain in the ass. Have you noticed that? Like, it's like they want you to find his freaking, this guy's great. Follow this guy if you like REITs. Barksdale, he's got, but he's an Excel jockey, and that's what we're looking for here. So, but here's what's interesting specifically was his commentary on, see, I already liked all this stuff.
I like how he's got some old wall sell side models. He scraped that off of his report. Yeah.
Yeah, this is cool. All right, so let's talk about this. So basically, for example, look at these. So here, let's look at some apartment REITs. I'm looking at EQR. See, Jamie, I'm not as smart as you. Okay. And so I like to just not only, of course, Jimmy and I know each other from various Twitter subcultures that are, data driven, quantitative,
Mhm.
and that's the way. But I like a good story too. You know what I mean? I like investing alongside the goats, and Sam Zell is certainly that. So I see, for example, a 21% discount to NAV, consensus NAV for EQR. Is that B REIT-ish? Like, is that number kind of like a B REIT NAV, or would you trust this NAV more than? And I know this is, I'm just showing you a random
Yeah.
thing, asking you to comment on. So
Yeah, I will say that this is more conservative than the B REIT NAV. So if you think about this, the consensus applied cap rate is an aggregate of sell side analysts that cover REITs that have their own methodologies about assumed cap rates based on what they see in the market, as well as some forward adjustments, perhaps based on interest rates. What a lot of private companies do, and think about it this way, EQR is one of the highest quality multifamily landlords in the country, in the world. They have studios in New York that go for $5,000 a month that no one can afford. And they
wow,
are serially 95, 96, 97, 98% occupied in those markets, which speaks to the quality of their assets as well as the kind of evergreen demand for people who need housing at that
yeah,
pricing segment, right?
right,
What we saw for much of the last 4 or 5 years, particularly prior to even COVID, when rates fell rock bottom, when the 10-year was hovering between 3 and 4%, companies that were able to tap into the unsecured market, publicly traded companies, found themselves being outbid by private families who were getting debt at higher cost, but they were able to lever their assets 80% versus 40%. So, when you look at cap rates, you see sub 4% cap rates. So a very quick skinny on cap rates is like, you can think about, you can think about a cap rate as kind of the unlevered net operating income that
yeah,
a particular asset can generate, right? Includes operating expenses, taxes, repairs and maintenance, but it doesn't really, it's leverage agnostic because the cost of debt financing is not calculated. And based on how the company is structured, there are debt costs associated with levering up a company, but to the
right,
equity, when you have a positive spread between what you're generating from the asset itself and where your cost of debt is, you can boost your leverage or your return to your equity shareholders. But we found ourselves for many, many years where cap rates for the highest quality assets were below, or were, the private market was at a substantial premium to the public market. So that offered a a secular tailwind for these public companies to say, we've got the best assets, we should be trading at a premium to the private market. Now here we are, that 4.7 cap rate, I can guarantee you, if EQR were to liquidate their entire portfolio, however billion dollars they are now, I mean, they're a large company, they're a big fish. In a free market auction, their portfolio would probably trade at a 4 and certainly inside of 4.5. So intellectually speaking, when you think about the pool of global liquidity that's out there that's looking to buy these irreplaceable assets that they'll never want to sell, that this is their trophy portfolio, one can make an argument that these public companies are very much discounted relative to where a private market might trade. But here's the other argument. When you're a large player like BREIT and you've been gobbling up all the real estate and now there's no incremental buyer, is it even possible for EQR to liquidate their portfolio? If they had to have a distressed sale, who could gobble up what institution today, with the cost of financing that we have today, could write a check for, $20 billion or whatever the enterprise value of the company is? And there's more sellers than buyers. There's forced liquidators. There are players who are involved in both private markets and public markets. And when they can't get out of their private funds, they have to get out of their public funds, because they have a risk officer at the pension fund that says, hey, we have to reduce our allocation to real estate. I hear about these thematic risks across the portfolio.
And you think that could be part of what's weighed on REIT share prices?
Definitely from a flow perspective, yes. And the other part about the discount that you see, you look at the company today trading at north of a 5.5% implied cap rate. So the implied cap rate is based on the current share price. What is the market implying that the underlying asset is generating on an unlevered basis? What this tells me is that, one, earnings next year is going to come down. And the tricky thing is, when you're at 98% occupied and you are an asset with you have a lot of operating leverage and you can break even when you're about 50 or 60% occupied, every percentage of occupancy goes right to your bottom line. But it also works the other way around. So when you go from 98 to 95, the incremental loss in cash flow is much more exacerbated. So there, particularly in the real estate community now, there is a clear expectation that debt costs will continue to increase, that occupancies will continue to decline from trough levels, that discounting will also increase. So the funny thing about apartments is, in a traditional, in a normalized market environment, you might get 1 month off for a 12-month lease. And EQR, being the high quality company they are, they might only offer you 2 or 3 weeks. We went from 2 years ago in the depths of COVID, where you were getting 3 months off of a 12-month lease effectively, to a market that was so tight that there was no concession. So the funny thing about concession is, when a tenant turns, there's repair costs, maintenance costs, and all of this is in the books. It's averaged out, it's smoothed out from these accounting numbers, from AFFO, from cash flow. But on a real cash basis, we are now entering a cycle where more and more people are going to turn over in search of better deals. And that incremental turnover results in increased costs. It results in lost rent. If you're in a market like New York and you're 98% occupied, here's the math. 98% occupied is 1 out of 52 weeks. That's 1 week. If it takes you more than 1 week to backfill your vacancy, even if you were to bump up that rent, you're losing money, right? You're losing money on a cash flow basis because of that 1 week of occupancy that you have on your books. So if the 1 week turns into 2 weeks, turns into 3 weeks, and you have to add 1 or 2 more weeks of concessions, you can see quickly how companies that are structurally running at 98% net effective occupancy are going to lose a lot of cash flow. So there's, chalk it up to conservatism, to pessimism, to fund flows, but to also this kind of waning tide that we've seen for the last 10 years. And, to get through it, we have to go through it.
Yeah. And so, so cap rate is cash flow versus NAV. And so when you're talking about it trading in above a 5 cap rate, you're saying because basically the price is so low that it's the implied cap. Okay, did I just say that right?
Yeah, the implied cap rate is determined on the price of the equity, right? And it's telling you that the based on the stock price today, the company is generating an unlevered, I wouldn't say free cash flow, right? Because there's CapEx, there's G&A associated with it that's not included, but on a pre-G&A, pre-CapEx, the collection of assets, right? The aggregate of the cash flows is trading at 5 or 5.5% on the value of the asset itself.
So what does increasing the cost of capital, or does it have an effect? Generally speaking, because actually I'm in Southern California. We're in a desirable part of Southern California here. And my understanding is cap rates are very, very low because investors are willing to bank on price appreciation, essentially.
Mhm.
What is raising, or what is a significant increase in the cost of capital? Would that generally lower cap rates across the board or raise them, or does it have an effect? Do you think about that?
Academically, the cost of debt financing is removed from the calculation of
Right.
implied cap rates, right?
I understand that. Yeah.
And the goal of that is to be able to compare two companies with different structures. Imagine EQR and then imagine a clone of EQR with twice the leverage. Now, if you were to on paper, the implied cap rate doesn't change, but you'll typically find that companies with lower leverage have higher quality earnings. So in the public market, there is typically a premium or some type of additional consideration to companies with cleaner balance sheets. Now we could talk about cash flow to the equity, and you would see a difference there. Maybe a levered vehicle might spit out more cash flow, but get valued at a lower price to FFO multiple to offset some of that increased cash flow that an investor might look at. But the truth is, whether it's individual or institutional, and the story, when interest rates are low, people can afford to bid up the price of any real asset, because a lot of the times we back into our monthly payment, we back into cash flow. So we're coming out of a period of very, very artificially depressed cost of financing metrics, where cash flow was juiced because people were able to lock in low interest rates. And therefore, the market transactions for the highest quality assets that always had financing readily available, that always had buyers available, the realized cap rates, the implied cap rates of all these transactions got pushed lower and lower and lower. And now that is no longer the case.
Yeah, no, that totally makes sense. So could you look at, interesting, and what I'm trying to get at is just picking your brain on when eventually, what eventually will make you attracted. But let me tease that out a little more. In real estate investment trust, just to set that up a little bit more, let's start here. So could you almost look at real estate opportunities, buying a rental for your family, buying EQR, buying Realty Income, ticker symbol O, which is more of an I guess you call it a triple net office type situation. Not really office though, but it's triple net. You call it triple net. I guess you retail REIT. Those are three very different investments, or a private REIT that you're, we won't name names, but your guy's trying to sell you. Aside from firing your guy, what would you look at cap rates? Could you just look at a cap rate across the board, and that kind of tells you what's, it gets you leads you in the right direction as far as where the opportunity is? Or is that way too overly simplistic to? Yeah, I don't know. How do you think about that?
Yeah.
How would you think about normalizing real estate investment opportunities?
I think the first comment I'll make is that, just like the broader market, companies and investments within a particular asset class have a higher correlation to each other than to the broader market, but they also have a correlation to the broader market. Because real estate can be subdivided into different property sectors. You talk about multifamily, industrial,
right,
office buildings, commercial, malls, strip centers, data centers, what have you.
Yeah.
It's first, I think, imperative to see at the sub-asset level, at the sector level, what is the cost of financing? What is the secular demand for such an asset class? So it would be a lot harder, even though you have an index that might have a particular free cash flow yield, that might have a particular implied cap rate, it would be difficult to compare them to just a risk-free rate. In fact, the joke is that in real estate, after a while, everyone becomes a historian, because in order to orient yourself to what might happen in the future, there's a lot of backward-looking relationships between asset classes. There's a lot of backward-looking relationships between availability of financing between each other. You know, like you can track implied cap rates across residential through the years, 20, 30 years, through healthcare, through malls. But when we think about a lot of the changing forces in real estate, particularly, you know, we barely touched on offices yet, but when you look at asset classes that have structural impairment, or that there is a perception that the future use case of the asset is not what it used to be, then you have to throw these relationships out the window, right? And then you have, we talked about cost of financing. We look at equity REITs. We also have to look at CMBS spreads. We have to look at investment grade corporate spreads. There's all these different pieces that come to it. So for me, what I've found most, you know, when I've been bolted to the chair as a dedicated REIT, you know, investment analyst, is looking at relationships within sub-asset classes to each other over the years. So that what is the spread between higher quality landlords and lower quality landlords within a particular capital market environment? And then traditionally, what is the spread between the broader real estate sector to risk-free rates? And what's tricky about the landscape that we find ourselves in now is that with the 10-year having, you know, experienced a massive climb off the zero bound, with bond volatility even just kind of zigzagging in a really unstable range, it's hard for, when we don't know what the risk-free rate is, it's hard for us to assign equity premia to any investment we make, right? That's like a general rule. So for so many years, the credit spread, both the equity spread and the credit spread to risk-free rates, because rates were so low and people were looking for yield, and REITs became a bond proxy. You're clipping a coupon and you got some capital appreciation. You couldn't do that in the bond market. So for a while, the spreads were very, very tight. Maybe it was 200 basis points, right? But it was 200 basis points when the 10-year was at 1.5, and the REITs were yielding 3.5% on an after CapEx basis. And that was if you're a pension allocator, sign me up. I'm getting 200 over. But now yields are over 4%. But now the 10 years back down, right? We have a very, very inverted yield curve. That's another thing to think about when it comes to, you know, what that means. But at the short end of the curve, not where a lot of these companies get their cost of financing, but if they have floating debt, 100%, right? The larger companies are able to access 10-year unsecured markets, although I would argue that the credit market, for all intents and purposes, has been frozen. The transaction market's been frozen. The credit markets are frozen because people don't want to show that number, right? There's almost an ostrich method where people don't want to. If your cost of capital was 5% on your debt, and you had a better quality portfolio that used to get 3% on their cost of debt, you don't want them to put up that 5 spot, right? If you're the CFO of the company, you don't want to come to terms with what that means for the quality of your portfolio or the ability for your portfolio to get financed. So there's kind of this, you know, the bid-ask spread is wide. There's a game of chicken right now. And that's where BREIT finds itself in. And a lot of these REITs find themselves in, where how does my portfolio compare to the best assets in the market? And when the freeze happens and these best assets are starting to get re-rated, what does that mean for my portfolio? So people don't want to take their marks, but clearly things are trending in the wrong direction.
It's wild. And I think that just thinking about office, right, to your point, I was just thinking of a couple of names on this sheet here, and it's wild how big of differences we're looking at, right? So within office, well, first of all, I should start here, really. I mean, I think, it's interesting that the first chart I had up there, gotta get back there, but the navigating with Zoom is so fun. Sometimes the screen gets in the way right when you need it. But the point I'm trying to say is that the correlations between subsectors of REITs, and that was something I'd sent over to Jimmy yesterday, that Phil Bach and Meb Faber. I love Twitter, man. I mean, like, Phil Bach and Meb Faber are guys. I've talked to Phil Bach personally, but Meb Faber, never talked about. Listen to this guy talk for hundreds of hours, and so it's so cool to be able to learn from people like that on a real-time basis. But they're talking about factor investing and how it never really took off for REITs, but it definitely had, obviously for stocks, it's become huge, but for REITs, it never really took off. And so the point I'm getting at here is that it's interesting how even within office, though. So, like, what I want to show you guys is within office, there's huge discrepancies, right? Not even going. So here's the various. Come on. Let's just do this. Cool. So yeah, there's you get it that there's definitely so what was interesting is someone had commented that there's probably not much diversification within the REIT subsectors, but Phil showed them with this. I'll try this one more time. Phil showed them that actually that's not true. There's large amount of diversification.
In fact, within REITs,
go ahead.
It's one of the kind of it's now a gig sector, but it's one of the sectors every year when you backtest this for 20, 30 years with the highest dispersion between the winners and the losers. So it lends itself to a lot of long short activity. There's a lot of, we talk about Millennium, Balyasny, a lot of these hedge fund pod shops that run market neutral. It is one of the sectors where the correlation within the subsector, I think you can see that here. There's room every year to pick winners and losers.
That's well said. I didn't know about the dispersion thing. But yeah, exactly. And I think that, this table, these correlation tables are always kind of funny, but yeah, you can look at it down this way or over this way. And, the point is that there's, hotels and healthcare are not correlated. Self-storage and hotels are not correlated. So there's definitely some non-correlated elements of the REIT subsectors. And to your point, that's something people got to keep in mind. I won't keep.
And this is even further exacerbated by market size, because you have small cap REITs, you have large cap REITs, you have a whole variety of factor exposures where there are years where if you're in the S&P and you're getting passive fund flows and there's a quality bias, your stock will go up. EQR and another data center company might have more in common from a correlation perspective than EQR and a smaller, higher levered, third tier apartment landlord, if you know what I mean.
Yeah, for sure. No, great point. Yeah, look at BXP, looks like poopy. OFC, which I don't know that much about, but I understand
before you get out of BXP, I joke about being a historian, but it's more importantly than the fact that we've broken through the COVID lows is I want you to look at I want you to take a look at a 10, 15 year chart of this company. This is one of the highest quality companies in all of the world when it comes to commercial office. I want you to take a look at where the cycle peaked for commercial real estate. The cycle peaked in the December of 2014, 2015, when we were at a mid-cycle from an operating perspective, but the foreign capital, you heard about the Chinese, the Japanese, all the fund flows were coming in to the sector. Not atypical that expectations are the highest when, you're in the middle of the cycle and you're dreaming about what that end goal looks like, and the cost of capital throughout this period, right? 2009 to 2014, it was a one-way ticket down. So before the WeWorks, before the work from home, things came into play. But for a company that is as well regarded in the real estate industry as a whole, from private equity to brokerage firms and everything, that's a lot of value destruction.
wild below the GF or the COVID lows because, and not to put you on the spot here, but I guess just people are really concerned with, how can OFC be that? They're just totally different businesses, I guess, that are structured differently, and they must have different. They must be very different. Just looking at the charts, wild out there. So let's so on real estate, let's kind of maybe put the cherry on the Sunday here, because I could pick your brain on real estate stuff all day. Clearly, I don't really know what I'm talking about, but I think it is interesting, and I think that real estate investment trusts of liquid traded real estate is a really interesting thing to watch in my world, and in my opinion. What gets you interested? Just more pain, more bloodletting? What do you want to see? Or is it just you just know it too well and you're just not interested? Maybe like I am with private REITs. I'm not to say I know private REITs too well, but I know enough to know that I'm not interested.
That's a great question. I think for anyone who's a little too close to knowing how the sausage is made, there is some of the desirability, the ability to dream, the inner workings, some of that goes away. If I have to break it down for the viewers, I think the biggest factor is interest rates. And right now we are in a very unstable interest rate regime, whether we go up or down, because there are impacts to the economy. But the fact is, I don't think we have the chart with us today, but if you look at historical free cash flow spreads of not just the broader index, but when you look at a lot of sell-side research reports, they can break it down by sub-asset class. What is the historical apartment spread, the relative industrial spread, the relative commercial office spread to risk-free rates? That gives you a sense of how these relationships look at the beginning of a cycle, mid-cycle, and at the end of the cycle. And clearly, this was in the context of a 40-year bull market for bonds. So all of this was being clouded by the fact that cost of debt financing continued to decline as the use case broadened. But now we're on the other side of it. And for me, there needs to be a capitulatory moment for the equities. So I don't think the spreads have quite gapped out to even historical measures coming off the zero bound. So for a company like EQR that by that chart says it's at a 5.9 implied cap rate, that in a vacuum looks attractive on an absolute basis. So the unidimensional analysis to that is, I know that residential homes trade between 2% and 4% cap rates because historically people buy homes on emotion. They bid up prices by taking on more debt when interest rates are low. They're not actually renting out their own homes to other people, so they don't think about opportunity costs, the idea of an implicit rent, right? If you paid $1 million for a house, you're living there, but how much could you really rent it out for? And on an unlevered basis, what is that cash flow yield? So multifamily and residential, a 5.9% is much better than you could do investing in single family homes or thinking about your own property, what someone's willing to pay for your house. But again, when I look at, just 2 years ago, there was no risk-free option. You could not park your capital and earn, 2%, 3%, 4%. But when there's a 4% bogey out there in the risk-free market, the academic thinking is, with all the fundamental headwinds, with us coming off the peak, we're late cycle. In 2009, we were early cycle because the destruction had already occurred. So we went into 2009 and 2010 with most property sectors at trough occupancies, trough asking rents, and at that point, the capital markets just started to improve. So if you think about, that as kind of, right, the saying is like, you want to buy when there's when there's trough earnings, trough multiples, and trough sentiment. We found ourselves in 2009 with trough earnings because occupancies had escalated, trough multiples because there's no bid for real estate assets during the GFC, and then the sentiment improved once we build out the finance system. But here we are at the end of the cycle. Today we have, really peak earnings. You could say that the multiples have shrunk as a measure of, a forward-looking view on real estate. And the sentiment is nowhere near the peak, right? We still haven't marked down our portfolio yet. We still haven't drank the bitter medicine.
Yeah, man, that's really, you broke it down very nicely. That's very well said. And so the earnings, multiples, sentiment, and I think you hit the nail on the head. So we're closer to peak earnings, sentiments, whatever, somewhere in the middle, and then multiples have maybe come in a little bit, but on what earnings number, we don't even know.
Especially when it comes to earnings, because a lot of sell-side analysts will use a next 12 months, kind of a forward-looking cash flow projection. And so we always overshoot to the up and to the down. Even if the buy side number is materially lower, there are not a lot of sell-siders that are willing to risk their profession and say, I think we're going to have a 15% decline in your earnings, right? I think we're going to have this occupancy loss, this asking price loss, this increase in vacancy or concession. So the sell side aggregated research always tends to be backwards looking. So on a spot NAV or on a spot cash flow, you're definitely still at peak or slightly past peak. But when you look at the next 12 months, even if the investment community is appropriately conservative, the marks have to come. And the joke is, it's never all priced in. There's always a person that is the uninformed volume that pukes, just as growth companies that shoot up, even when people who are very close to the story feel like things are rich, whenever companies exceed expectations from the sell side community, there's always the uninformed volume that has a bigger dream that is able to push companies higher on the way up.
Yeah. Very, very some great points you bring up there that I think are that I need to kind of just sit with and chew on.
This was painful.
Yeah, here's mortgage REITs. Yeah, let's save mortgage REITs because I think we could do a whole show on that, and I would love to just pick your brain on mortgage REITs. But the chart looks like death. What else was I looking at? NURE. Here's short-term REITs. So here's a lot of like hotels and stuff. It's interesting here. Let's go through it just to wrap on this. And I got a couple small cap questions, and I'll let you get out of here if that's all right with you. Here's HAUS. Here's our boy Philly Back of B-REIT fame, B-REIT thread fame, as we were joking about for the show. But he's a great guy, friend of the show. And he's, I think him and David Arback, this is their fund here. HAUS obviously looks like crap, but it's early. I mean, it just came public in March. But not a lot of love there. Industrial
that was the peak when you look at the year-to-date chart before people started.
They probably came in right here.
Yeah.
Oh, this is the NASDAQ industrial. I meant to say INDS is also Pacer Industrial Real Estate. So it's like, so for the viewers at home, this is like Prologis and what's some other industrial real estate names?
Prologis has gobbled up most of these companies, but you had Duke, which was acquired by Prologis, First Industrial, which was acquired by Prologis. A lot of companies out there. There's a smaller East Group Industrial Property Trust that's still there, just a few $1 billion. And here,
so the fund's 21% PLD and then 15% PSA, and yeah, some storage REITs and stuff, or whatever. I don't know how industrial that is, but anyway. And then the last one, VNQI. I looking at this. So this is I was watching some videos about this, and tell me, this is the danger of a little bit of knowledge is you can do dangerous things with it. So VNQI. So these guys all use IFRS, right?
That's correct.
So these guys are basically, is that so what that means, and again, Jimmy's the expert here, and I'm just picking his brain. What that means, I understand, is that so they're marking down NAV as the year goes on. Like how often do they? Is it constantly updated? Like how does that? Do you know how often that gets marked up?
I don't know if this is an exercise that we can do now or if it's something for our viewers, but when a company uses IFRS accounting, what you can do is every quarter when they report their 10Q or their quarterly financial report, you can go directly into the MD&A. And there's a section that talks about valuation methodologies. And what you'll see is that there is a lower bound for cap rates, a higher bound, an upper bound for cap rates, and then there is the ascribed, right? It's the audited cap rate for the assets. And again, it is then adjusted by a particular vacancy loss factor to arrive at some mathematical stabilized occupancy, which may or may not reflect the portfolio as a whole. So often in times of incoming distress, where imagine the BREIT portfolio, right? They are not immune to any of the macro challenges, the fundamental pressures that any other sector has. Let's say they have a multifamily portfolio within BREIT that was stabilized at a 97.5% occupancy, which is where we found ourselves at the peak of the cycle. And today, there's seasonal aspects of it, but today they're earning, they're 95.5 or 96% occupied. The NAV calculation will take a trailing cap rate, which is more aggressive because it's lower, then apply it to a higher stabilized occupancy and a higher asking or a higher market rate to arrive at a triply inflated NAV that's not reflective of what's on the ground today.
Wow. Yeah. Look at the markdowns in these. And this is, as a history. So like let's wrap. I'll put a cherry on the real estate conversation here. But this is, I want to pick your brain more on this. I love it. And to your point, the historical nature is what's so cool about real estate, and it is fascinating. And VNQI, these are international names. So like number 3 is Mitsubishi Estate Company. Like what? Those guys don't they make cars? But they're doing all kinds of stuff. So I would love to learn more about kind of what some of these guys are, and I'm sure you've got a wealth of knowledge. Let's give the audience here something to go home with in case they're not real estate nerds. What have you been buying? Let's talk small caps. Let's talk babies that have been thrown out with bathwater. And I'm baiting you, but I know one you bought that I've been involved with. I still have a few shares. Here's a golf ball bouncing down some concrete staircase, which is where we like to look for ideas. Blade, very fascinating. That's one. Let's talk about it. I just want to kind of hear like what's interesting to you right here, and then let's come back to it, and we'll be able to watch it over as time goes on, as we keep coming back.
Absolutely. I think there are two important. There are two important caveats with this particular company. Blade was an early entrant into the Cathie Wood ARC funds. So on the way up, incredible excitement, incredible fund flow, momentum into the company. Not just during I think the company was EXPC, that was the SPAC. But there was an incredible amount of volume and fund flow into the thematics about EV takeoff and landing type aircraft and that service. But Blade in itself, unlike many REITs, raised a war chest. So the company has about $3.60 a share in cash. Now, one of the things that have come back to haunt a lot of small caps and SPACs in particular was that during the money grab period of 2020 and 2021, when a lot of these companies that probably should not have been public went public, they didn't take the time to raise additional opportunistic equity to stuff their war chest. people were, I don't know whether they were concerned with equity dilution or whether there were some funky things within the SPAC structure. If you recall, where before the de-SPAC period, there were options to redeem at $10 if it fell below, but if it went above, there were ways for the sponsors basically to pull out and to drain the company of its cash balance. So you would find often from a modeling perspective, a lot of these companies had uncertain amount of cash reserves based on the election of the insiders and how much they wanted to either stay in the company or get out of the company. And many small cap companies with, promising business models, or certainly stories to talk about, found themselves running low in cash, right? There's a whole cohort of private companies that never had trouble accessing capital. They always thought that we'll just raise equity when the time comes. And a lot of people, this is a very interesting thing that kind of bridges real estate into the broader equity landscape, is a lot of people that are not in the public markets think about, particularly if you're private, if you're like a VC, if you are a private equity guy, they think about capital calls, right? When I need to raise capital, I'm always getting 100 cents on the dollar. I'm finding incremental LP capital. I'm going out to the markets for a round, and I'm injecting my company at, with new capital at $1 per share. But the trouble is when a company is trading at a discount, particularly in the real estate sector, right? If the market is telling you that your company is trading at a 20% discount to some published NAV, and you start raising capital at that, you're only raising 80 cents a share or 80 cents to the dollar. So there's a strong dilutive effect, and it can be a self-fulfilling prophecy, right? The idea is if you have a premium cost of capital, you want to issue equity to buy things in the private market for $1. And if you're trading at a discount, you want to be selling your assets, realizing the actual NAV, if you can prove that your assets are worth more in the private market than they are in the public market, and return that to your shareholders. The problem with these SPACs and these VCs is they thought they would always raise equity at $1 or $2 or $3. And now they find themselves in year 2 of a 5-year business plan down 90%, having to either dilute their company by 5-10% a quarter in stock-based compensation, right? That's the hidden dilution that they never have to think. If your stock price is 6 times higher, the 5% dilution is 1%, and that's a lot more manageable, right? So we've seen that with all the growth stocks that now have stock-based compensation, like 30-40% of their revenues. Can you imagine that?
No, for sure. And I mean, obviously you can talk about the big mega cap, or, the big large cap Silicon Valley, stalwarts. But then, for example, like maybe to illustrate an example, I was reading some of so this is Graham F. That was the Jay-Z weed disaster. That's, absolutely just been a nightmare that I've unfortunately been involved with personally a little bit. And what's interesting is that about that is that, so Jay-Z gets something like 7 million a quarter in shares, $7 million worth, right? So now that the shares are priced at not $1, but 20 cents, and that's up 33% today.
Not $10, but 20 cents, right? So that's a what, 90? It's 98% dilution.
Yeah, something like that. And so it's only about a $10,000 rate of return I need to get back to even. But the point is, if I was getting $7 million a share, that's a lot of shares, right? So but the point is, this is an example of maybe not exactly what you're talking about, but in general, as share prices come down, now you're fire selling stuff at at prices that you never really wanted to realize a loss, and then you can get a self-fulfilling nightmare.
Yeah. Well, the good news is Jay-Z owns the company now. So
no, well, yeah.
He took the Bobby Bonilla approach, right? I'm gonna take that annuity payment, the 3-year.
Yeah. Well, good for Ho.
Good for him.
But the rest of us bag holders. So Blade, we like it. Obviously, it's not a chart pattern we're looking at. Jimmy's former buy-sider, Wharton grad. He won't tell you that, but I will. And the guy And so you're thinking that at $3.60 a share, stocks at $4. I mean, it's getting interesting here. And I tend to agree.
Yeah, it's getting very interesting for a company that has about when you look at the market cap and you strip out the cash, the company's worth maybe about $15 million in enterprise value, maybe.
Yeah. And last question on that is, as far as the enterprise itself, it's all coming along. Like I remember that, these guys came out in COVID, not a lot of people were riding in hell. It's a very compelling, I actually know people in New York, East Coast guys that it's a verb, right? I bladed to the city from whatever.
Bladed to the Hamptons, bladed to Miami.
Yeah. That's probably more people do. I bladed to the Hamptons. Yeah, exactly.
That's right.
So, but it's coming along. Business is coming along. They're, growing and all that good stuff.
Yeah. Which doesn't mean it's going to turn around, but certainly when I look at when I'm grave dancing like Sam Zell, when I'm looking at the graveyard of companies that are trading down to cash value or to zeros, this is effectively a zero, right? If you were a large institution and you're trapped and you've got millions and millions of shares, you're not going to sell at a $15 million mark. You're going to hodl it like Kathy has to. So there's a lot of companies like this, but we can go on and on. Got a whole list for you.
Grave dancing. That's maybe what we'll change the show title to. Cool. I want to be mindful of your time, but let's wrap here. Anything else? So cool. Thanks for giving the viewers here something to think about. I like Blade. Man, it's been a great teach-in almost on real estate and REITs. And I think that we're just scratching the tip of the iceberg here. Maybe to close out this week, anything else you're looking at or what else?
Yeah.
Any closing thoughts about life? What do you got?
No, this has been fantastic, and there's so much to talk about. There's a lot of similar sets in this market. When we go back to the liquidity bubble, and we talked about what liquidity does for risk assets. One of the things I've paid more attention in maybe over the last month or two, is to the crypto NFT community. So not just the price of Bitcoin, but for many of us that haven't followed some of these Web3 non-fungible tokens, a lot of this DeFi, decentralized financial infrastructure that is still very, very nascent. These you can almost think of them as derivatives of the main layer that is Bitcoin. And the reason why I bring this up is, I got my bag holder sweater, Santa bags, and technical analysis. This is something that I think we'll continue to touch in the next couple of sessions. Technical analysis provides a great context for where buyers and sellers have come in and come out. Now, that is not reflective of the fundamental or intrinsic value of a company, but from a market participant standpoint, it can clue us in to where there are levels of support, as well as where there are volume nodes that are more likely to get sold into. And so one of the things that has me concerned is when I think about the entire crypto infrastructure coming off of this double peak that we saw in 2021, Bitcoin is down 75%. A lot of the altcoins are down 90+%, 95, 98%. A lot of NFT projects, we'll spend some more time talking about this in a future session, but sometimes you just have something like a Bored Ape. It's a picture. It looks kind of cool. Maybe it gets you like a membership perk into something. But a lot of these non-differentiated, non-zero utility kind of pieces of art, they were created in an ecosystem where the price in the underlying currency had risen tenfold, but the currency layer itself might have risen 1,000-fold, right? If you think about the rise of Dogecoin and Shiba Coin, these started as, nano pennies per coin, and they rose astronomically. So you have two layers of total collapse. You have collapse in the underlying currency, and you have a collapse in the value that the currency is represented in. So the simple example is you had a piece of art that was sold for 1 ETH back in 2019, right? The people who got in early, they saw the price of Ethereum go up 100x.
Yeah.
And that artwork that went viral went from 1 to 5 ETH. So you got a 5-bagger, or you get a 4-bagger on the ETH, and you got a 100-bagger on the currency itself, and you find yourself a paper millionaire. Now what we see is the currencies have collapsed, right? Ethereum is down 80+% from the peak, but whether you're holding that piece of artwork at 5 ETH or 1 ETH, the fact is there's no liquidity. So
Yeah.
what I see as a multi-year impediment to the continued development of the Web3 NFT ecosystem is that at any given price level, you're going to have trapped bulls. They're not even bulls, right? But you have trapped bulls from a currency perspective, and you have trapped bulls from a project perspective, because a lot of these projects that turned out to be shilling pump and dumps, right? Silly pictures that went viral. Their moment has come and gone. So not even if the currency recovers, you can't get out of your project because no one wants to buy your project. And if your project recovers and goes viral again, you might be held in a captive ecosystem, let's say like Solana, which is down 98%. So you're still bag holding because of the currency, the underlying currency. So there's just a lot of complexity and layers. And it doesn't negate some of the innovation and the enthusiasm that I see, particularly amongst Gen Z and a lot of these digital natives that have embarked on these entrepreneurial journeys. But we're talking about, if not a lost generation, a lost 3 to 5 year period where there's, I don't see a lot of structural support or tailwinds for these, really marketing schemes, right, that are masquerading as risk assets to really make a comeback.
So here's but here I guess would be my question is like, why, of course, everything is an investment of time, right? We're both family men. Time is the most precious commodity, not even close. Money's pretty close actually, and so in health maybe is above all that, but and so you can only spend so much time on so many things, and so you can't you can't make money on the short side, or tell me I'm wrong, or it's very hard to,
there are some ex-US exchanges that allow you to speculate on margin, but again, in any size with institutional relevance, you're talking about retail gambling.
And well, I was just gonna say more like my issue there would be counterparty risk. Like, okay, I'm great, I made a bunch of money, and now I can't get the money out. So,
case in point, whether you're long or short, right? If you were an FTX betting against the market, your collateral is gone.
Right, because FTX was one of those places where you could short perps and all that good stuff. So I guess my question is, so it's hard to spend a lot of time allocating to studying it because you can only make money short side. But then even long, like I was watching something that was like I think it was just Instagram. It was like the 49ers gift exchange last year, minimum $1,000. And I think I saw 2 of the guys got NFTs, and so now he's got a JPEG, it's completely, there's no utility there. You can't live in it. You can't. So I guess that's, so I see where there's bathwater, but what I'm interested in, and I'm not the person that would necessarily be in the know about this, but what I'm interested to see is, as these prices careen, if this has a long way to go, where is the utility, or where is the value on the other side, or where is the baby? I understand where there's bathwater, but where is the baby? I don't know if you have any thoughts on that.
Yeah, the nature of the decentralized Web3 thesis is that you have these autonomous organizations and everything is controlled by its own community/user base. So different projects have different types of utility. We saw Trump come out with his own NFT today.
That's right. That's right.
For $100, maybe you get lucky and you can visit him in Mar-a-Lago, right? So some things can have meme value.
That's right.
Other projects, like what Starbucks has been able to do, is they recently announced a project where they can onboard a lot of their legacy clientele that pays in US dollars, that, you go to Starbucks, you buy something, you get these gold stars, right? You get these points. When you reach a certain number of stars, presumably you're eligible for this NFT program where you can get a special profile picture, you can get a special digital token, and that token presumably, as is written by Starbucks right now, you can earn a rare trip to Costa Rica to see this plantation. So there is a lottery perk, right? It's
Right.
not something that can be quantified in terms of cash flow, but
Yeah,
depending on the project itself, one could argue that there is some hypothetical utility.
for sure.
Now, a lot of that is still a derivative of the base project, right? If Starbucks goes bankrupt, your NFT goes to zero. It's not
Right.
untethered from the existing ecosystem. And that, I think, has been the biggest misconception or misunderstanding that a lot of people that seek convexity, that seek the 100x returns in crypto have, because in pursuit of their own ecosystem to take full control, right? Power to the users and not to the legacy institutions that sell the users data, and like we are the product, we can become the owners. There are all these correlations and counterparty risks that are, I think, intellectually dismissed, that in this environment should be at the forefront and that
Right.
should merit further scrutiny.
For sure. And back to the original conversation on real estate, it's like if real estate hadn't gotten there yet, where we're starting to think about, then yeah, especially imaginary internet money, and I am sympathetic, and I forgot if I already said this, but from an anarchy trade perspective, I really am sympathetic to the whole thing. Here's a chart of over OSTK, right? That's Alder laying eggs, Mark Cohodes of FTX fame. He's been on this for many years, or for years, and I've been interested in what he's had to say about it. And they've got their T0, right, which is like a tokenized exchange. And so they're definitely, and this is something this is down big this year, right? We went from 110 to $20. So you've got a lot of pain. There's an e-commerce business. I'm not here to pump the stock. I'm just saying that, and I'm not involved actually, but I'm very, but the point is there certainly are use cases, and there's a tokenized exchange for buying and selling stock. Yeah. And you talk about an industry where there's a lot of legacy. You talk about an industry, or where you wouldn't build it from scratch the same way or anything near that. I think that's the exchange business, right? Or the financial services.
Yeah. I'm going to spend 2 minutes on this company.
Please do.
I want you to also look out, let's say 5 years,
let's do
even
it
longer.
You talk.
For those of you who are familiar with Overstock, this was kind of the also ran of furniture. My wife, she'll look at Wayfair, but she's like, Overstock, like, no. But the company as constructed has a cleaner balance sheet. They're not saddled with debt like a lot of their competitors. But this is a company that was an also ran that at one point was on the verge of bankruptcy and irrelevance, that then caught a massive, you can see these kind of meme squeeze a tire, right?
This chart is hilarious.
Look at this chart.
Look at imagine investing in this company, and just you would be crazy, like Patrick. Keep going.
And then again, going back to technical analysis, from a fundamental perspective, I think there is some intrinsic value in T0. I'm not very well versed, but they have a crypto platform that seemingly seems to be of higher repute than some of what's happened recently. They have a captive market share in their retail operations, which they are a distant third. But if something were to happen to the competitors, any percentage uptake in market share could result in drastic upside from a fundamental perspective. But if you go back to the 1 year chart, this is reminiscent of many companies that have fallen. When you fall 60, 70, 80%, at one point it looks like a zero, right? But here we're still well above COVID levels. So when you look at where this is, May of 2020, right? Like when you look coming out of COVID, we're above COVID levels. This company was a sub $10 stock before COVID. So anyone who's been hodling this company still has gains to project, but the vast majority of ownership over the last year are at much higher levels. So I continue to be cautious. This market, even when there is value, there are a lot of trapped bulls. So just when you scroll most recently, you've got a lot of people in at about $25, and now it's kind of broken down to a year-to-date low. You've got people at this $40 shelf, that $40 to
Look at all this
$55
volume there.
range. Yeah, you got
Yeah.
all that volume that participated in the mean squeeze. So like they are in easily north of $50. If you start looking at July, from July to that, the much like AMC and GME, you had these squeezes, right? These moments in time, unlike maybe a little bit like crypto, because crypto had a May peak and then they had that November peak that we saw in the 2021 chart. But you've got these different volume nodes where at each peak, at least in November, there wasn't a lot of volume, but the vast majority of people in this name are underwater by 50 or 60%. So unless there's a step function and something fundamentally changes, we haven't even talked about equity investing as a series of interconnected factor exposures and how that's changed
Right.
from just the investing landscape from even 5-10 years ago. So this company and a lot of other companies have some tough sledding ahead to do.
Well, there you have it, folks. I think that's a great place to end for the inaugural episode of Jimmy Real Assets. Super fun, Jimmy. A lot to learn from you. I think we just scratched the surface. And so send us a like and subscribe, blah, 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 the stuff you got to say with the YouTube video. Follow Jimmy on Twitter. That's a great idea. Jimmy Runs Money, I believe is right, your handle.
That's right. Yeah.
And pop questions, comments below. Jimmy's got he's a wealth of information. So we'll let's try to do the same thing next Thursday, Jimmy.
Absolutely. Back
yeah.
at it. Back at it.
Back at it, like we never left. My man, great talking to you. Thanks for watching.